Hey, Jenny Kassan here. I'm out and about in my car, but I wanted to be sure and talk about how to raise money for your business in alignment with your goals and values, and do it in a way that lets you stay in control of your business and not be forced to sell out to investors that are going to want to become your boss. So what I said I would talk about today is something that is becoming more and more popular as a tool for raising money. So one of the big decisions you have to make when you're raising money is, what to offer to investors. So the first part of that decision is what type of instrument. So the big decision is debt versus equity. And then, of course, there's also things that are sort of a little bit in between debt and equity. So, for example, there's something called a convertible note. There's something called a SAFE, a simple agreement for future equity. Those are kind of a little bit in between debt and equity. But basically, the decision between debt and equity is one that's very important, because if you offer something that is debt, you are making a commitment to pay it back over a certain period according to a certain schedule. And that just doesn't work for a lot of businesses. If you're a little bit earlier with your business and you need some time to kind of develop your business, it's going to take a while to start making enough money in your business to break even. Debt is not going to be a good choice for you, because debt does require that you actually start making payments on it. Now, don't get me wrong, debt can often be a great tool. It doesn't have to look anything like a bank loan where you have to make monthly payments, and if you're one day late, you have a late fee. I've raised money with debt many, many times, and I love debt. But if you are the type of business that's going to take several years to have positive cash flow, or maybe you're the type of business that's going to need a big loan for a real estate deal or something like that, you really want to raise money in the form of equity. Because equity is inherently patient capital. It doesn't have to be paid back really ever. And you can get really creative about how investors get paid. So let's say you're like, okay, I know I shouldn't do debt because my business is going to take a while to break even. There are many businesses that can take 5-10 years to break even, and that's totally fine. And if that's the case, debt is probably not going to be a good choice for you. So let's say you do equity. Now, a lot of people think that if you offer equity to your investors, that the only way that your investors can get paid is if you promise them that you're going to sell your business. And sometimes I'll see people will prepare investor presentations, what we call decks, and the deck will have a slide that will talk about, like, here's who we see as who might buy our company in the next 5 to 7 years. But a lot of my clients don't really want to be forced to sell their business on the timeline of an investor. Not that you would never want to sell it, but to have an investor who's breathing down your neck, bothering you, like making sure your sole focus is putting your business into a condition that it's going to be able to be sold as quickly as possible, at high a price as possible. A lot of people just don't want to do that. So the good news is you can offer equity and your investors can get paid without you having to sell the business. So I just wanted to talk about one tool that you can use to do that, and we call that like redemption. There isn't really an official name for it, but you could call it like revenue-based equity or redemption-based equity. And so the way that works is you get your equity investors. They buy stock or, a membership interest, a stock in your corporation, membership interest in your LLC. And I'm going to just tell you one scenario. There's lots of different ways this could look, but I'm just going to kind of give you an example. So you could say, okay, I'm selling stock in my corporation for $1 a share. And so someone could buy some stock in your corporation, and then you could say, every year I'm going to look at my cash flow, or I'm going to look at my revenues for my company, and I'm going to take a percentage of my revenues and I'm going to pay them out to my investors, but only if I can. If I'm not profitable, if I'm not meeting my obligations, I won't make a payment. But to the extent that I have some cash available to make a payment, I will pay a percentage of my, let's say, my gross revenues, or it could be like your gross margin if you want to deduct out the costs of goods sold or something like that. It's whatever you want it to be. But a certain percentage of, let's say, your gross revenues, you pay it out pro rata to your investors, and that payment is buying back the stock from them. So like if I bought let's say I bought like $100,000 of shares in your company. So I bought 100,000 shares for $1 each. You could buy them back from me at a higher price. Like maybe you say, I'll buy them back from you at $2 a share. So let's say in year 3, you send me a $10,000 check, which is my share of your gross revenue. And then that $10,000 buys back 5,000 shares. And you keep doing that every year, and eventually you will have bought back all my shares. Or maybe some companies say, we're not going to buy back all of your shares. We're just going to buy back, like, let's say 90% or something like that, because maybe the investor doesn't want to totally exit from their investment. So I hope that makes sense. It's a really cool model. There's a few investors out there using it. It's basically a way that you can have equity investors who exit slowly from their investment over time. And they're making money as you go along, as you're making more and more money. And eventually they can be completely out, or they can just go down to a much lower percentage. So you own a bigger percentage of your company when all is said and done. And you don't have to sell the company for them to make money. Isn't that cool? So if you want to sell the company, great. They can make money that way too, but it's not the only way. So I hope that made sense. It's a little bit of a complicated structure, but once you kind of wrap your head around it, it's pretty awesome. So that's all I want to say now. I will be back at the same time next week. In the meantime, I have lots and lots of resources on my website, so feel free to go to jennykassan.com. I have lots of downloadable free resources available, also upcoming events that we're having, so feel free to check that out, and put a message in the comment section below if you have any questions about this or anything else. See you next week.